Okay, today we want to begin looking at Chapter 2, Gross Income and Exclusions. So we want to look at and discuss what's included in gross income and then what would be excluded, we would be allowed to exclude by law. And so in your packet of information that you received, you should have received a handout that's titled Gross Income and Exclusions. And what I want you to do as I go through the PowerPoint and discuss, you should be able to complete those sentences and fill in the blanks as you go through this entire chapter. So this entire chapter will be done with PowerPoints. I'll do some examples. But as you look at the PowerPoints, you're going to want to fill out this information. And so therefore, you have a good set of notes for Chapter 2, which covers gross income and exclusions. So let's go ahead and get started. For gross income, basically the IRS basically says all sources of income are included in your gross income unless it's specifically excluded. Okay, so it's an all-encompassing thing. All income is included from whatever source derived, they said, wherever you get it from, it's included. Even non-cash, it's not specific to being just cash only. Non-cash items have to be included in income at their fair market value when it was received. So it's going to be all included. So let's look at the top of page 2-2 in your book, Table 1, and it gives you some specific inclusions. And there's just a few that I want to point out. Alimony, and we'll look at that in more detail. Alimony is included in your income. Also, I want to point out bonuses, back pay, all that's included in your in your income. Employee awards are included in income, so all that's included in income. Gambling winnings are included in income. And then also included in income is any income from illegal sources. So illegal income is included in income, and you're thinking illegal. How if it's illegal, I can't see someone who is getting income from a legal way that they would include it in their income. And generally they don't. But what happens is a lot of times when you see criminals arrested or high crime individuals arrested or do time in jail, they'll say for tax evasion. And because they can determine that their lifestyle is higher than what maybe they reported on their tax return, therefore there must be some other income. It could be illegal income, and therefore they would have to include that in income. And if you look under would you believe it, I want to point out what they have here on page 2.2. They mention income earned illegally from any source, including drug sales and organized crime, is taxable. Al Capone, who headed an enormous violent and profitable crime organization, eluded conviction for criminal activities until 1930 when he was sent to prison for tax evasion. So keep that in mind. Even from illegal sources, that should be included in income. And then something that's not covered in your book that I wanted to point out to you is that there's 3 different classifications of income. We have active income, which is income that you actively earn from wages, self-employment income, and salaries. All those is considered active income. I actively earned. Portfolio income, basically dividends and interest, is income that you earn from investments that you have, your portfolio. And then your passive income, income from partnerships and real estate investments where it's earned, but you're not actively involved in the partnership, so it's considered passive income, or you're just part of the real estate investment, you're not part of actually running the real estate, then it's considered passive income. So 3 classifications of income: active income, portfolio income, and passive income. Okay. Also, before we get to that slide, at the top of page 2-3, they also give you a list, table 2, of exclusions, items that are excluded, that the IRS says you don't have to include these items in your income. And a couple of those: accident insurance proceeds that you get from an accident, inheritances, life insurance proceeds, and we'll go into a little bit more detail of that, welfare payments, worker compensation, gifts, there's child support payments. All those amounts are excluded from income, and you do not have to include them in your income. Also, I do want to point out something that the IRS is going to start doing in 2011. If you look at Would You Believe on page 2-3, for all those who purchase things off of different websites and use PayPal accounts, when you're selling things, and that should be included in your income if you're selling things on those different websites. And so the IRS has decided, because they know that there's a lot of income going through that PayPal, those PayPal accounts that's not being reported. So it says here, the IRS recently has been examining transactions records for PayPal, the online payment firm. The IRS suspects many taxpayers have not reported income earned from sales on eBay and other sites that you may be using. Beginning in 2011, certain large PayPal payment amounts must be reported to the IRS automatically. So the IRS is going to have PayPal's report to them automatically. They'll put a dollar limit on it and say, I don't want to say a dollar limit, but they'll put a dollar limit on it and say any transactions over this dollar limit must be reported to the IRS directly. And then what the IRS is going to be doing is expecting to see those payments or that income on the corresponding taxpayer's tax return. So keep that in mind. Okay, let's briefly look at this self-study problem on page 2-3. Problem 2.1. It says indicate whether each of the items listed should be included in gross income or excluded. So let's look. Prizes and awards are included in gross income. Embezzled funds are included. They don't care if it was legal or illegally. Child support payments are excluded. Alimony included. Pension included. Inheritances are excluded, not included in your income. Welfare payments are excluded. Bequests are excluded. Jury duty fees are included. So if you receive, what you do sometimes get a small amount of a fee when you are on jury duty, that's included in your income. Royalties are included. Life insurance proceeds paid at death are excluded. Hobby income included. Rewards are included. Partnership income included. Casualty insurance proceeds are excluded. GI Bill benefits are excluded. Scholarships for room and board are included, and we'll look at that in more detail. Mileage allowance included, and then gifts are excluded. So that was a self-study problem 2.1. Okay, let's look at interest and dividends. Interest and dividends are reported on Schedule B, and they are required, to be reported if you have more than 1,500. You can report them all if you have less than 1,500, but they're required to be if you have more than 1,500. And then if you look at the top of page 2.4, they talk about gifts and services that you may receive when you open an account or you have a long-term deposit. So if they give you a gift or they provide some kind of service, then that should be reported as interest income on your tax return. Okay? On page 2.4, they talk about U.S. savings bond or U.S. government bonds. Okay? They start out and they talk about what we call Series EE bonds. These bonds are issued at a discount of face value. So for instance, maybe the face value of a bond is a $50 face value, but I only have to pay $10 for it. Okay? And let's say that it matures in 10 years. So it increases in value over the years, and that increase in value is considered interest. So if I buy a $50 face bond and I only pay $10 for it, that $40 difference is considered interest and it's taxed to me. Okay? Series HH bonds, they're issued at face value, meaning I buy a $50 bond, I pay $50, and they pay interest twice a year, and that interest is reported in the year that it's received. So they pay interest as they go via check twice a year. So that interest is income, and it's reported in those years that you received it. As of August the 31st of 2004, they no longer issue these Series HH bonds. So there may be people out there that still hold the bonds, but they don't issue those bonds anymore. And then we have Series I bonds, they are also issued at an amount less than face value, and as it matures, it increases in value, and then that interest is, in that case, paid at maturity. And so the question is, how do I report interest on these Series EE and I bonds? You can pay interest when the bonds mature, when you cash them in. So you can wait to that point. So back to my $50 face value bond that I pay $10 for, it matures in 10 years, I get $50. At that point, I report the $40 worth of interest. Series I bond, I held for 10 years. They pay me interest on it when it matures, and therefore at maturity, whatever interest I receive, I will report on my tax return, and it's taxable interest to me. Or I can elect to report the increase in value on a yearly basis. I don't have to wait till they mature. I can choose to make an election, meaning something in writing with the IRS, and say, instead of waiting till the bonds mature, I want to report the increase in value every year. So back to my $10 bond, my $50 face bond that I bought 10 years, and it was $10. Every year that increase in value, I can report on my tax return and make an election, opposed to waiting until it matures. And then also on page 2.4, 2-4, I will not read them to you. There are some rules. You either report the interest on these bonds on a yearly basis by making the election, or you wait till they mature. Now, there's some rules if you decide to switch, from doing it yearly versus waiting till they mature, or vice versa. So there's a whole paragraph of those rules on page 2-4. Just be aware that the IRS has some rules, and the rules regarding that. You just can't freely switch back and forth in how you report the interest on these bonds. Okay, let's look at dividends. Basically, dividends is what you're going to receive from a corporation if you have stock in a corporation and they choose to pay dividends. They have what we call ordinary dividends, and this is basically a return of net income. That corporation is going to pay you dividends out of their earnings and profit. So basically, you're getting part of their earnings. And then we have what we call non-taxable distributions, that opposed to them paying you dividends from their earnings and profits, they're going to pay it as a return of capital. So basically, they're going to return back to you what you've invested, a part of what you've already invested. And what that does is it reduces your basis in the stock. Okay, so let's say that they pay you ordinary dividends, and then at some point in time they give you a return of capital, and as they give you that return of capital, it reduces your basis. And let's say if your basis is reduced all the way to zero, meaning I have no more basis in it, and I still get a distribution, that's considered a capital gain distribution. Those are those distributions after your basis is zero, and it's going to be taxed as a capital gain, and it should be reported on Schedule D. So a return of capital is taxed as a capital gain and should be reported on Schedule D. Now, there's preferential treatment for the tax of dividends, If you look on page 2-5, they give you current tax rate for dividends. And dividends get lower tax treatment. If you are a person that is in the 10 and 15% tax bracket, for 2008 to 2010, you will pay no tax on your dividends, 0% on your dividends. So as you get ready to file your 2008 return, if you had some dividends, and if you were in the 10 to 15% tax bracket, meaning orderly, all my other income is going to be taxed at the 10 or 15% rate, then my dividends, I would pull those out, and I would have to pay no tax on those up till 2010. Anybody in a higher tax bracket than 15%, then your dividends are going to be taxed at the 15% rate for 2008 to 2010. So excellent benefit for dividends. They're taxed at a lower rate. Now this is strictly for qualifying dividends, And they have some rules there on page 2-5, what is considered a qualifying dividend. Basically, dividends that are qualifying or gets a special tax treatment are those that were held, those who held the stock for more than 60 days during a 120-day period beginning 60 days before the stock's ex-dividend date. And so you're thinking, what does all that mean? When your company gives you a 1099 div, which is where they report those dividends to you that you received, they will indicate, there's a box that indicates that if it's a qualifying dividend. So you won't have to try to guess and worry, is it a qualifying dividend or not. When they report to you on a 1099 div, they will indicate by putting the amount in the qualifying dividend box so that you'll know that the dividends you received were qualifying dividends. Now, if it doesn't meet those qualifications and it's a non-qualifying dividend, then basically it's just going to be taxed with your other income and taxed at your ordinary income rate. So it just wouldn't get the special treatment. Okay, let's look, before we move on to the next slide, at self-study problem 2.2. So I want to do that problem with you. We have Bill, and this is on page 2-5, we have Bill and Betty Brown. They received the following dividend and interest income during 2008. So they have some dividends, interest, and some non-taxable dividend. What they would like for us to do is to complete a Form 1040 Schedule B, and then also do the calculation to determine the tax, okay? So that's what we want to do. We want to first report the income and do it on a Schedule B. And they have one on the next page in your book, so you can just simply tear it out of your book and let me locate mine, and then we can do that together. Okay. Okay. This is a Schedule B. A Schedule B basically is on the back side of a Schedule A, where you report your itemized deductions. On the back side is a Schedule B. Your name would be here along with the Social Security number. And at the top is the interest. At the top is where we want to report our interest income. So we want to look. Notice they had interest in Ford bonds, big savings and loans, and then U.S. bonds. So we want to put those, and they have a line for each with corresponding places for the amounts. And then also down here is where you report your dividends, is where you report your dividends. So let's begin by putting in our amounts. We had, for interest, we had Ford bonds. And that amount, and that Betty received that. And this is a joint return, is $425. And then we had the big savings and loans. And that's $2,150. And then we had U.S. bonds, which is $175. Okay, and that's basically all you do, is you make sure, and then it says add the amounts. So we want to add up $425, $2,150, and $175. And so my total interest is $2,750. It's $2,750. No excludable interest that they mentioned from EE or I, and so therefore the total amount, $2,750, would go there. And then it also goes on the front page of the 1040. And let me pull out a 1040 for you real quick so you can see where that would go. So what we would do is we would carry that right here where we have taxable interest, attached Schedule B if required. And remember, it's going to be required if you have over $1,500. And we had, what, $2,750, so we would put that there. Okay. Now, note, we had some tax-exempt interest. They had non-taxable distribution from Western Gas and Electric. They don't say if it's interest or not, but we're going to assume it is. But notice that it would go there. Okay, tax-exempt interest goes in 8B. Now, it's not part and it's not tax, but when we put it in there, we're going to use it for other purposes. So let's go ahead and put that there. So just keep in mind that it would go there. And so next, we would deal with our ordinary dividends versus qualified dividends. Okay, so our dividends that we have is we have IBM. Oh, let me move it over so you can see it. We have IBM, and I think both of them received some IBM. $275 for Bill, $175 for Betty. So we have $450 for IBM, and then we had GM of $450. And then we had AT&T of $750. So that is our total dividends. And when we total those up, we get $16.50. So it says here, scoot that up. Let's add our amounts up. Okay, then they tell you if line 6 is over 1,500, you must complete part 3. And it's regarding foreign, so you want to answer those questions and deal with that. So that's how you complete the Schedule B. And so they go ahead and they gave you some additional information. They tell you the Browns had taxable income, including dividends and interest, of $40,000. So remember, our dividends are taxed at a separate or different rate, So also in the book, they wanted you to complete this form. Which is a form where we calculate the tax on qualifying dividends. Also, capital gains are taxed at different rates, too, and we'll deal with that later. So we just want to deal with the dividends right now. It starts off with enter the amount from 1040, line 43. Basically, they tell us that their taxable income is $40,000. Okay, then they want to know the amount from 1040, line B. And so what would happen is, once I filled out this and I got my $1,650, I didn't go over that, then we want to put it here, $1,650 on the front of my schedule, in front of my 1040. And then notice they say qualifying dividends, and they give you a page where you can determine if they're qualifying dividends or not. But remember, the 1099 div should indicate that they're qualifying. So we want to put it there as well, because there's special tax treatment, and which is what we're doing now for the qualifying dividends. Maybe this was the total ordinary dividends, but maybe not all of them were qualifying. So that's why they have two separate items there. Okay, so let's continue doing our calculations. So enter the amount from 1040, line 9B, which is only the qualifying ones, which is the ones that receive the special tax treatment. So that's what they want us to put there. And then they say, are you filing a Schedule D? In this case, let's say we have no other capital gains. That will be on Schedule D. And we're going to say no. And it says enter the amount here from 1040, line 13. And then, which we don't have anything there, but then add lines 2 and 3. So we're going to go ahead and carry down our dividends, which is $1,650. And then we're not claiming any investment interest, so we're going to leave that blank. And so then we'll add those, and we put our $1,650 again. And then for 7, it tells us to make a subtraction. Basically, if this is my taxable income, which includes the dividends of $1,650, I want to pull those out. $38,350. And then 8 tells us to enter the smaller of the amount on line 1. And then if you are single or married filing jointly, it would be $32,550. And they were married filing jointly, 65. I'm sorry. It says enter the smaller of the amount on line 1, or $32,550 if you're single or married filing separately or $65,100 for Mary Fallon jointly. And they are doing a Mary Fallon joint return. So the smaller of $65,100 or $40,000, which is line 1, would be the $40,000 on line 1. And then it asks us, is the amount on line 7 equal to or more than the amount on line 8? And then we're going to say no. And then they tell us to enter that amount on line 7. Okay, and then it tells you to subtract. Basically, you're taking 9 from 8. So basically, it just gets you back to your dividends again, your dividend number. Now, 11 says, are the amounts on line 6 and 10 the same? And they are. And it tells us yes. So if they are, then we can skip lines 11 through 14 and go on to 15, which we will do. And then it says, figure the tax on the amount on line 7 and use the tax table or tax computation worksheet. So I showed you those tax tables last class period. So we would go back to the tax tables, Mary Fallon jointly, and then we would look at $38,350 and come up with the tax. And the tax on that amount is $4,954. And then there's nothing here. They wanted us to add those, so that just carries. It tells us now to figure the tax on line 1, which figure the tax including the dividend. So the amount on line 1 is $40,000, which includes the dividend. So obviously it's going to be a higher tax, $5,201. And then it'll tell you to pick the smaller of the two, which is $4,954. And then that would be the amount of your tax that would go on the back of your 1040, where it says on line 44 tax. So that's where that would go. You figured your tax. You have not taxed your qualifying dividends at all. So you were in the 10 to 15% tax bracket, which totally, when you got ready to figure your tax, which totally left off your dividends. And so it was not included in there. So that's just a little, as you can see, the forms are kind of cumbersome. You really have to read every line and go through every detail to make sure you're doing exactly what they want you to do through the calculations. There's a lot of forms and a lot of worksheets in preparing tax returns that you have to fill out in detail. Okay, so that dealt with dividends, and we looked at the Schedule B, so you can see how we report that interest and dividends, and then also calculating the tax on dividends, which if you're in the 10 to 15% bracket, you don't have to pay any tax. Okay, let's go ahead and look at 2.2-6 and look at alimony. Alimony is deductible by the payer. So the person who's paying alimony gets to take a deduction for it, and the person that is receiving it is it's taxable to them. They're going to have to put it in their income. So deductible by the person paying it and taxable by the person who's receiving it. Now they tell us to, as far as to meet those requirements for alimony, if you were divorced before 1985, they tell you to use the tax laws at that time. And then if you were divorced after 1984, basically 1985, then you would use the ones that we want to cover here briefly in the book. So if you look on page 2-6, they talk about alimony, and the rules are really what they're concerned about is what is considered alimony. So that you want to be real careful when you're paying alimonies that you meet these requirements so that you can take a deduction for your alimony, because you want to make sure what you're considering alimony is going to be treated as alimony by the IRS. So on page 2-6, they tell you alimony payments must meet these following requirements. The first one is that they must be in cash, okay, and received by the former spouse. So I can't call it alimony and I'm paying somebody else for the former spouse on behalf of them. It has to be received by that spouse, that former spouse. So first of all, they have to be in cash and they have to be received by that former spouse. The second rule is the payments must be under some type of divorce decree, some type of separate maintenance agreement, some type of written agreement or a written instrument. So it must be something there that's requiring and stating that alimony payments be made. The third is that the payer must have no liability to make any payments after the death of the spouse. So if there's some type of liability that they have to pay, continue to pay, be it the estate of the spouse after the death, then it probably wasn't alimony. So it has to be no liability to continue making payments after the death of the spouse. Number 4, the payments must not be designated or in a written agreement as anything other than alimony. It can't be said that this is in payment of some debt or a liability, and then you call it alimony. So they're saying it can't be stated or written that it's something other than alimony. And then number 5, if the parties are divorced and they're legally separated, they must not be members of the same household. You can't pay alimony to someone who is in the same household as you. So you have to meet those requirements in order for it to be considered alimony, and therefore a deduction is received for alimony. Child support payments can't be disguised as alimony when they're really child support payments, meaning that I make payments, but when my child reaches 18, I don't have to longer make them. That means they were child support payments and not alimony payments. Okay, alimony recapture. Basically, Congress, they have these calculations that they look at, that if for some reason, let's say in the first 2 years or 3 years after a divorce, there's huge alimony payments made. You know, let's say, for instance, $1,000 a month. And then after those first 3 years, it states that they'll drop down to only $300 a month. That's considered front loading, and the Congress has said those are probably not alimony payments. Because if those huge payments were made at the beginning, it was probably for some other reason. And so then they're going to make you recapture. They call it recapture, meaning if there was deductions received in those early years for those huge payments, they're going to make you add back some of that you got as the deduction. So just be careful that there's not front end loading on those payments. Also, property transfers in a divorce situation, if there's property transfer from one spouse to another, there's no gain that has to be recognized in that transfer, and then that other spouse gets carryover basis. Let's look at the example on page 2-9. Jim is required under a 2007 divorce decree to pay $400 alimony and $250 in child support payments. Since the decree separately states that $250 is child support and only $400 is deductible him for alimony. So notice they're making two payments, that is child support and alimony, but it's specific. They tell us what the child support is, so therefore the remainder of it is alimony. So just keep in mind, be careful, make sure they're not really child support payments. Be aware of the property transfers and how property transfers, and no front loading. Let's quickly look at self-study problem 2.3. It says a husband is required to pay his former wife $12,000 in alimony in the current year. Since he is short of cash, he gives her an automobile worth $12,000, which she accepts in place of the alimony. How much may the husband deduct as alimony? It's, as far as I know, it's okay to make that substitution. But now what's happened is that $12,000 payment is not going to be considered alimony, not deductible by him, and she does not have to include it in her income. So even though the acceptance was made and the agreement was made, the deduction was lost because it wasn't in cash. Number 2, a husband is required to pay alimony of $2,000 per month to his ex-wife. However, the alimony is reduced to $1,200 when their child, who lives with his mother, becomes 21. How much of the monthly payment is alimony? So we got a $2,000 payment. It's reduced to $1,200. So that lets me know that $800 of that payment was actually child support. So therefore, only $1,200 is going to be considered alimony. Number 3, a wife is required to transfer $100,000 worth of property to her ex-husband as a property settlement. The property has a basis to the wife of $20,000. How much taxable gain must the wife recognize on the transfer? So the wife is transferring to the husband $100,000 worth of property, and technically there's an $80,000 gain in there, but there's no gain recognized at that transfer to the husband. But when the husband receives it, he has a basis of $20,000. So if he turns around the very next day and sells it, then he is going to have to report the $80,000 gain. So the spouse that the property is transferred gets the same basis that the other spouse has. So in that instance, it would be $20,000 basis, and then if they happen to sell it for $100,000, the husband would have to report the $80,000 gain, even though there was no gain reported on the transfer. Okay, so that's everything with alimony. Okay, let's just touch a few things on child support. Child support is not deductible by the payer and is not income to the payee. So child support is not included in income. Now, something very interesting here is that the payments for your child support must be up to date before any payments paid may be treated as alimony for tax purposes. And they state that on page 2-9. So if a taxpayer is obligated to pay that both child support and alimony, he or she must first meet the child support obligation before obtaining a deduction for alimony. So keep that in mind. It must be up to date. They're not going to let you take deductions for alimony if the child support payments are not up to date. So just be aware of that. Okay, prizes and awards. Prizes and awards. Okay, prizes and awards are taxable income. If I go on The Price is Right or whatever the show may be and I win prizes and awards, those prizes and awards, the new car that those people win, are going to be taxable to them. That's taxable income. There are some exceptions to prizes and awards. To an employee, they can exclude awards up to $400. And then if the award is part of what we call a qualified plan, then they can exclude up to $1,600. Okay, so just know prizes and awards are taxable. Let's look at a couple of examples and things on page 2-10. The example, Van enters a drawing and wins a new automobile. The automobile has a window sticker price of $20,000. The fair market value of the prize should be included in Van's gross income, but the fair market value is probably not the window sticker price. Instead, it's the price that which a similar car would have been sold for. So just be aware of that. The Would You Believe It? It says television Survivor winner Richard Hatchett was sentenced to prison for failing to report $1.4 million of income received from Survivor and other sources. A Justice Department official said our nation's federal tax system is not a reality show to be outwitted, and it is reality, period. So very serious about having to report that income that they win on those shows, the Survivor shows, and Want to Be a Millionaire, those type of things. Another TV extravaganza caused the IRS to emphasize the rule that taxable income, all income from whatever source derived. The Oscar show's gift bag. Oscars, they just announced the nominees. So think the Oscar show's gift bags. When the Oscar shows get close, they'll be talking about all these things that they're going to receive in gift bags. All these very valuable things, you know, from jewelry to vacations, all those things in those gift bags, including more than 100,000 Hawaiian resort vacations, chocolates, and other goodies, were subject of a 2006 IRS press release reminding the presenters and performers that the bags qualified as taxable income. And the last statement, and the saddest recent taxable prize was the free ride to space that was received by Brian Emmett. So Brian Emmett won a free ride to space. He was a software consultant, He won that in 2005, and he had to give it up, his seat, when he discovered that he would have to pay more than $25,000 in taxes because that trip was valued at $138,000. So just keep in mind that those prizes and awards are taxable. Okay. Next, we want to look at annuities. Actually, before that, let me do the self-study. I want to make sure I get those self-studies in, because those self-studies are just kind of give you more examples and more practices. Self-study problem on 2.4 at the top of page 211. For each of the following independent cases, indicate the amount of gross income that should be included on the taxpayer's return. Okay, we have Helen. She enters a radio contest and wins $2,000. It's included in her income. In 2008, Professor Deborah wins an award of $10,000 for a book on literature she published 4 years ago. The award was presented in recognition of her past literary achievements. $10,000 included in her income. Bill is a professional baseball player because he hit 50 home runs this season. Then he's given a new watch worth $2,500. So that wristwatch is taxable income. And then John is an employee of Big Corporation. He's awarded $5,000 for a suggestion to improve the plant layout. So that's included in his income. So all those amounts are definitely included in his income. So just be aware. All right. Next, we want to look at annuities. Annuities basically is, they speak of annuity when someone retires. They've either purchased an annuity, or they'll take their entire retirement or something they get and transfer it over to annuity, where they get payouts of periodic payments for the remainder of their life. Okay, and those periodic payments are determined by the purchase price of the annuity and plus their life expectancy. So we're talking about annuities, these periodic payments. Okay, there's a general rule that they talk about on page 211. And basically, amounts received from an annuity by a taxpayer, you're going to have a taxable portion and you're going to have a tax-free portion. Okay, they're not going to make you pay tax on the portion that you invested or used to purchase the annuity. You're going to have to pay tax on the earnings that you receive. Okay, they have an exclusion ratio that's on page 211. And how do I determine the amount that's included in my income versus the amount that's excluded in my income? So let's look at that general rule calculation that they show you. So remember, I have this annuity. Okay, and so my question is, I'm going to be receiving payments. What amount of those payments are taxable and what amount is excludable, meaning that I don't have to include in my income based on those monthly payments. Okay, now what would be nice, but the IRS doesn't let us do that, is we say, let's say that I invested $5,000 in the annuity. That's not a lot, but just for instance. And then that I'm going to receive over the next how many ever years, that I would like to just say, okay, everything I receive up to $5,000 is excludable. And then anything after that, I will just include it in my income. The IRS doesn't say that. They make you do a portion of it every time. So basically, that general rule is going to take that payment and say, of that payment, a portion of it's taxable and a portion of it's excludable. They're not going to let you just say, oh, I think I would just rather do it that way. So what we'll do is make sure we'll pick up here on the annuities on the next time and go through the calculations of the general rule, and then there's some other a simplified method that we want to look at with annuities. So make sure you're working on your multiple choice questions at the end of the chapter. All those are always due. And after chapter 2, you'll have a test to do. So make sure you're keeping up on your reading and keeping on doing the multiple choice questions. So we'll pick up here in the next session.